So we start 2018 with a bang, with a nice good move, with a very similar move today that we saw at the end of 2017. So a persistent theme in the markets right now. I'm going to break down what that theme is, how it impacts stocks and different sectors. I'm also going to break down too what should we expect out of this near-term bounce. Should we expect that typical near-term run? Are we on an intermediate pullback right now, as much as it doesn't look like it today? So I'm going to break down the technical picture as well. And then finally, today's trade idea takes advantage of a stock that had a little bit of a breakout move with some decent volume. So let's go ahead and get started. My name is David Settle, and this is my market outlook for today, Tuesday, January the 2nd, 2018. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Subscribe to my YouTube channel by clicking that red subscribe button right there below the video. You can do that while you're watching. Also, hit that thumbs up icon right next to the subscribe button. That lets me know that you like today's video, that you want me to do it again tomorrow. Scroll down even further and comment on anything that stands out to you from today's video. I'd love to hear what you're learning, what light bulb moments you have. Finally, in the video description, there's a bunch of links down there. Subscribe to my email newsletter, my daily email newsletter, by clicking on that subscribe link. That will get you an email that has a timestamp summary of everything we talk about in these market outlook videos, as well as a list of all the bullish or the overbought and oversold clusters that are in the S&P 500. You can follow me on Twitter for more content throughout the day, throughout the week. You see my my address at the top, at DavidSettle42. Always pinned to the top of my timeline is tonight's market outlook tweet. Like and retweet that tweet just to make sure that Twitter keeps pushing you my content throughout all the different accounts that you're following. Finally, join the market outlook community on Facebook. You'll see the address at the top as well. You'll also find a link to that community group in the description. There's over 700 people that listen and watch these videos like yourselves. So join that community and let's share what we're learning and what we're looking at day after day. Well, all right, let's take a look at the market forecast today on the S&P 500 first off and see the big drop that we had on Friday closing at the low. In fact, quite the range you'll see in a few minutes, closing right at the 50% Fibonacci retracement. All of it, a lot of it coming in the last like 10 minutes, but last 30 minutes of trading on Friday, heading into the end of the year. You can see the 62% Fibonacci retracement lines up with that old near-term high point there from this one back in December. We did drop down to below 50. So again, after another, we have to duplicate that now because that's this is another near-term low point here. Well, you can kind of see what I'm doing with these ovals. I mark them according to these near-term lows there, and that was a more of an extended one going through the Christmas holiday, and then now I just need to duplicate this and put it in between there. So that's a really small one. And again, these are basically small. Anytime that the near-term line peaks above 50 and anytime it drops below 50, that's when you get these near-term highs and lows. So that's what these ovals correspond to. So you notice we're getting a lot of ovals. Like you see, we weren't getting a lot of ovals over here, and now we're starting to get a lot more ovals. A lot of near-term volatility. You've heard me talk about that before. The momentum line spiked down to practically zero. Well, it did get down to zero on Friday. Spiked right back up to 99. So big reversal and new all-time closing high today as well. I believe we got up above these highs too, 26.94, and we closed at 26.95. So we closed above those old high points today. So a good bullish close, and again, doesn't change anything in terms of, in fact, now we've actually got to duplicate that one because now we're in the process of forming a new near-term high point, and duplicate this or change that color to green. So look at all the, I mean, we're practically getting a near-term low point, a near-term low every week, and two in the last week, in the Christmas holiday week. So we're getting a lot more ovals. Before we'd go 7 to 12 days, which is typical to go 7 to 12 days 7 days is 1.5 weeks for a near-term low point. 10 days obviously would be every 2 weeks we're getting a near-term low. So now we're getting one every week practically. And that's what we've talked about. When you're at the end of in this case, a 4 months. See, we crossed above 50 at the end of August. We're now past the end of December. So when you're at the end of an extended intermediate run, and that's a long run for when intermediate runs typically last 1 to 3 months, depending upon where market sentiment is when that intermediate run starts. We were already relatively high, just a little bit below 70. So maybe 1 to 2 months we were talking about expectations wise. We got well beyond 3. Now we're going past 4. We've talked about this before and compared it back to last year, the beginning of the year, where February was kind of that 4th unexpected month of an intermediate run that pushed us up to that March 1st, really big move day there, and then that's what sparked this intermediate trend and this intermediate pullback. I'm looking for a similar thing in January this year, that we'll get an oval, an orange oval, which marks the intermediate low points, and the intermediate line drops below 50. That's going to be somewhere probably in this area here as we head down to 23% Fibonacci retracement down to this 38% line. You can see, in fact, we have to move the market sentiment run up now, and as well as the intermediate line high point. So that's what those Fibonacci lines, the Fibonacci lines, this is the intermediate run that we're currently on, and you can see where some retracement support levels will be. And then of course the market sentiment run started back here when the intermediate line market sentiment came up from below 50, and this is the current market sentiment run that we're on, and you can see where its support levels will be as you get more of a deeper pullback. If and when that happens, who knows? I mean, that's, we're trading at all-time highs, and significant bear markets or bearish trends don't start from all-time highs. We have to kind of mess around for a while and form, what would be a much higher intermediate low point, and then break that intermediate low point before we really even start to consider extended bearish runs. So obviously nowhere close to that right now. If you take a look at the Dow Jones Industrial Average, you can see again still strong bullish posture. It did not jump up to a new all-time closing high today. Its near-term line still below 50 for a second day. Again, setting up for potential bullish near-term low point, but getting again more near-term volatility, more highs and more lows in a small space signals a mature bullish intermediate trend. I know there's a lot of people talking about, well, we're gonna, I've heard a lot of projections that, we're going to be really bullish heading into the new year. And January is, typically January can be a really weak month over the last 20 years, according to seasonality. But, not a lot of people put that much stock into the fact that, we're already 4 months into a run right now. It's hard to start a new 3-4 month run, or I wouldn't even technically expect a new 4 month run because that's abnormal. So I wouldn't expect a new 2 to 3 month intermediate run starting from today, because we haven't pulled back on this one. We haven't formed a new orange oval yet, a new intermediate low point. And it's hard to start intermediate runs when you haven't had an intermediate low to bounce up off of. So that's why I'm expecting, again, nothing too bearish, but enough of a pullback here into this area, 2600 to 2625, where you have some Fibonacci support. Enough of a pullback in there. And it doesn't have to be sharp drop. It'll probably be really slow and grinding, but enough to pull the intermediate line down, potentially pull market sentiment down from very lofty levels, and then give us a much better opportunity for a new intermediate run. The Nasdaq Composite bounced off of a higher low point. You can see its near-term line had also come down below 50, forming a bearish near-term high point right there, a lower high. But basically coming down to 6,900, where there's some support from an old high point here, bounced off of it, and a new all-time closing high today. So market sentiment, momentum line, getting up to extreme highs, but that's not that big of a deal because we weren't really bearish. We were at 80.37, so still above 80, and now we're easily, now we're 82. So continues to show a strong bullish posture. don't expect it to last, too much longer. Doesn't mean we have to be really super bearish, but we also don't have to be really as nearly as bullish as we've been either. You can see the Russell 2000 had a nice little bounce too today, pretty much recovering all of what happened on Friday, keeping its bullish posture intact. But you also notice, again, we're still trading under 1550. And the high of that long upper shadow, 1560 essentially, is acting as a resistance level. So until we really break through that, our upside potential is going to be more limited. The long-term chart continues to rise. You can see we're still above, way above the 50-day moving average, even further, obviously, above the 200-day moving average. The gap between the 50 and the 200-day moving average is rising so far this week. Obviously, 2 days in, we still got 3 more trading days left. And again, that's not as high as it's been because of how high the index is, but it continues to grow, continues to get to very strong levels. Bear markets don't start at these strong levels. So at worst, we slow down. And I've mentioned before in my Outlook video, my 2018 Outlook video from last Thursday, that we're probably more looking like this right now than we are looking like this. That we'll get this kind of year in 2018 more so than this kind of year. I don't expect that kind of year yet because I expect that we have to resolve a lot of this. We have to come down from lofty bullish momentum, long-term bullish momentum, before we even start thinking about significant downturns, fall off the cliff type downturns. If you take a look at the 3 green arrows, you can see we still got the red arrow on the MACD. It's still below its moving average. It's still grinding. This is why I think we'll get an oval. Usually when these get down below 0, we get an oval. We didn't quite get one there. On that pullback, we did get below the 30-day moving average, got three red arrows and bounced. But you can see all these other times that we come off these high lofty levels ends up in an oval. So that's why I think that's there's a strong possibility that we'll get another one of these in January. An intermediate pullback. Just not anytime soon because, again, MACDs, when it's this high, it slowly makes its way down towards 0, and we're still above the 8-day moving average. We finally closed below the 8-day moving average Friday, but right back up above it today. So, and again, closing up to all-time new highs. And the stochastics still below its moving average. Made its way back up above, this 80 level here, or just a smidgen below it, but still below its moving average. So again, as bullish as it looks up here, because we're above the 8-day, the 8's above the 17, both above the 30, everything's rising, so it looks really bullish here. But the fact that they're both at high levels and below their moving averages suggests that we're starting that slow grind of a strong bullish downturn. Right now, a downturn when you're weakly bullish, when you're kind of weakly bearish, and it turns into a more stronger bearish, then things get really crazy to the downside. But things don't get crazy to the downside when you're coming off of a strong when you're starting a strong bullish downturn like this. So that you can see the craziness on the intraday chart from last Friday and then today. So last Friday we gapped up strongly to right close to the 4-week high point here, and then came tumbling down, especially in that last 30 minutes and the last 10 minutes, really breaking through 267 significantly and holding that break for the first time all week. And we even kept going down in the after hours to the low 266. Then we gapped up, kind of reversed all that. With a strong move to the upside Sunday night and heading into Monday morning. And then you can see closing at the highs of the day, breaking through the 4-week high point, breaking up through last week's high point, which is right there, which was Friday. Last week's high point was on Friday at the open. Last week's low point was on Friday at the close. And you can see all the other 3 days after Christmas were just really small and flat. And then a lot of volatility. And you can see a big range today because, again, you have to account for... when you look at the range here, you have to account for the gap. So we closed at 266.88. The low was at 267.40. So about 2/3 of a point that we have to add on to the range today. You can see the volume at 76 million, not as high as it was on Friday when we got to close to 100 million. but after multiple days around 50, so double the volume on Friday of what was typical for the holiday, after the holiday. And then today at 76 million is right on par with where it was the week before Christmas. And then again, the range there at 1.41 points. So you add on that 2/3 opening gap, and you're looking at about a 2-point range, which is high on average. And 70-some-odd million is relatively high. It's still below the, the average got pretty high here, but so it's still below and bringing that line down, but that's not coming down. So these are high levels. You keep getting volume in the 80,000, or excuse me, 80 million or higher in trading ranges of 1.5 point or higher. Those are bearish days. That will lead to more volatility and more of a pullback than will to the upside. The upside, you want volume, you want days where volume's under 60 million, or 55 million or less. You want trading ranges of 1 point or less. And what's interesting is the volatility has really dropped down at extreme, has dropped back down to extreme lows on an absolute basis as well as on a relative basis, getting, way coming down today back to below 80%. So very extremely low volatility corresponding to relatively high volume and high trading ranges. So, and if you look at that volatility index again, you say, okay, you take a look at it on a monthly basis. Obviously, this is January, in the range at 1.5 points. We're looking. You look for about 4 to 5 point ranges on a monthly basis, and where is that range going to come from? We're not going to drop down to 4.5 most likely. We're most likely going to move that high of 11 up to around 13 or 14. So we're going to expect that volatility to come up to the upside. And I mentioned also before, the quarterly volatility, 6 points, got really low. And of course, even more importantly, the annual volatility was really, really low for 2017, just about 8.72 points there. Again, last time we had it that low was back in 2005. And after that, the next year, volatility nearly doubled on our trading range. It finished the year down, so that's why I'm not expecting a down year this year. But I am expecting more volatility because of how small the range was for the VIX last year. So again, January, I'm expecting some volatility this month. We're not starting up, at such high levels here. We're not starting the month at 15. So at some point in time, you expect. So you can see the months here, and you can see just about every month. In September, we started up around 13 or 14 and made our way down. Every other time where we started the month lower, at these relatively low levels, we hit up to these and then came down. Here was December, we started high and then came down. In September, we started high and then came down. August, we started low, made a move before coming back down. You can see July, we started high and then came down. Here we started low in June, and we got that move by the end of the month up to around 14 or 15. So every month we tend to get a move, to get that 4 to 5 point range. We're starting low this time, so we expect sometime by the middle of the month, probably around options expiration, which are where a lot of these are at, that we'll get a jump up in volatility to 13, 14 before moving back down and starting a new intermediate bullish trend. All right, now let's transition into what's driving the market action today. And remember to follow me on Twitter as I post some stuff like this throughout the day. Again, you just find my page here, twitter.com/DavidSettle42, and you can see there's my handle at DavidSettle42. There'll be a follow button over here on the right. And remember, too, that if you want Twitter won't show you all the tweets of everybody you follow. Otherwise, your timeline would just explode, depending upon how many people you follow. They will show you the tweets of people that you engage with the most, and the tweets that have the most engagement from those accounts. So the more that you like and retweet, even if you don't have a lot of followers yourself, the more you like and retweet my tweets, the more Twitter will keep pushing you my tweets. And the more people that do that, the tweets will be engaging, and they'll keep showing that. So you can see, like these numbers have dropped off a little bit, probably because of the holiday here. But if you like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. Again, that will help ensure that Twitter keeps pushing you my stuff that I put out throughout the day. Interesting numbers here today, as you can see what really led the market well, these higher beta names, like Netflix. We talked about Netflix in our last video, had a really good bounce today after pulling back a little bit on Friday. Kind of took off today. So that was the kind of name that stuck out. Great quote here about how markets are born on pessimism, grow on skepticism, mature on optimism, and die in euphoria. And that's one of the reasons why I don't think we're headed towards a big bear market in 2018, because we're not on euphoria yet. In fact, we're kind of turning skepticism into optimism with all the fiscal accommodation that's coming out. So I think we'll start maturing. This bull market, this long-term bull market will start maturing in 2018, but I don't think we're euphoric yet. And that's when really bubbles start to burst, is when some asset class gets too euphoric. Let's take a look at what's driving the market action today, and you can see, you know, that weak dollar theme that I told you on Thursday's video was a key theme for 2018. Well, it continued. The year started out with a weak dollar, and that pushed up emerging markets, and that pushed up gold and commodities. You can see even crude oil lagged behind the stock market, but still was up on the day. With a strong move down in the dollar. And you can also see too that bond prices were down. So when you take a look at bond yields here, give it a second to load up, bouncing back up today up to 2.46% after really falling on Friday. And when it fell on Friday, you know, it had this kind of effect of bringing the expectations for a rate hike in March down significantly. So this is the March FOMC meeting, the Fed futures for that particular meeting, and these lines represent the contracts for one rate hike, which is being read, one rate hike by March. Now that we've had our December one, and then the purple would be no rate hikes by March. So we have the January meeting where nobody's expecting any rate hikes at all. You can see the odds of staying here at 125 to 150, which is where we're currently at, are close to 100%. So nobody's expecting a rate hike in January. But now you can see purple is to stay again at 125, 150, rising up pretty sharply. That's in March. So June, which is where, you know, the odds have been pretty high for a rate hike, continue to stay there. So it didn't. So while it dropped in March, it didn't drop in June. So the odds are still relatively high, you know, higher than any other contract. And you can see this one here is for, the gray line is for 2 rate hikes by June. So that dropped along with the 1 rate hike odds in March. But still, you combine those two together, and and this one down here, this dark blue, is for 3 rate hikes by June. Again, that would most likely include May, because the 100% odds of a rate hike in January, of no rate hike in January. So it's going to be more like in May that we get that third one. So March, May, June. And you add all 3 of those together, all 3 of these together, and you're looking at, you know, about 80% odds of a rate hike by June. So that was what came out of last Friday's kind of sharp sell-off, relatively speaking, compared to the other holiday sessions that we had. That was a fallout from that, and that didn't change today. So the market's still looking, and you can see with the long term. Now this TLT is not the short term rates. That would be like the 5-year bond or less, or T-bill or less. So this one actually is long term. So this is actually like 10, 20 years or more, and this is more tied to economic growth expectations, more so than Fed rate hike expectations. When you look at this one on a yearly basis, you can see, you know, we made a jump up above 2.45%, pulling back down during the Christmas week, but bouncing back up. And looking to continue to trend higher with this big kind of inverse head and shoulders pattern developing. You know, if yields continue to move higher on a long-term basis, then now that's a reflection. This is the 10-year note, but that's more of a reflection of higher economic growth expectations. You can see TBT is the is that long-term treasury. That's TLT. Is the bond prices. TBT is a short for TLT, which would of course be reflective of yields, and you can see how, you know, bouncy it's been down. TBT has been suffering. It's been down around 34, and if you look at it here on a long-term view, You know, we're down. It's down below its 200-day moving average, but looking like, you know, showing some signs of life here, and the potential, you know, getting above the 50-day moving average today, showing some potential for rallying. Whereas TLT, on the other hand, that's what it's looking like. So kind of an inverse. But the more this drops, the more that will be reflection of higher economic growth expectations. You can see that that wasn't the case all of 2017. The market was kind of fueled by expectations and hopes, but no real translation to economic growth. And there's a lot of chatter that that can make its way into the bond market by 2018 and start to lift rate hike expectations along with it. And if it starts to lift it up pretty sharply, especially if we continue to get more fiscal accommodation, then that can create more volatility in the equity markets. Not necessarily create a bear market, but start to create that higher volatility that we're expecting for this year, this calendar year. The sector rotation continues to show a similar theme to what we saw before this Christmas break, especially before Friday. That kind of sharp sell-off on Friday as things just re-engaged. So energy, which was the leader heading into today, best mover today. Materials up 3% over the last couple of weeks. Stock market basically flat over the last couple of weeks, but don't tell that to materials, energy, or industrials. All economically sensitive, economic growth sensitive areas. Discretionary doing well today, Netflix being a part of that. But on the other end of the spectrum, utilities continue just to get hammered. Utilities are down 5.5% over the last 2 weeks. That's a pretty big drop for a 2-week period, for a small time frame. To kind of give you a look at what that looks like here on a long-term view, we'll take a look at on the 5-year chart. You know, it's down below its 200. Utilities is down below its 200-day moving average. Now again, it was down below its 200-day moving average back here in 2016, you can see. But again, go back to 2013. 2013 was that year, and again we have 2014 where we've really took off. We had some volatility in the middle of the year, and then 2015 we had a good year. 2015 was really flat. You can kind of see in 2013, excuse me, again during QE, right in the heart of QE. 2014 was the tapering of QE, and then 2015 was the first year without it. So right in the heart of all that QE, when you had a strong, stellar year, we were right at the 200-day moving average there too. And then utilities had a good run in 2014, kind of leading that late stage market up, bull market up higher before, again, things kind of got crazy in 2015 with everything. So similar pattern that we're seeing here in 2017, making a run back really quickly down to its 200-day moving average. Again, you wouldn't expect a sharp move lower, with that to be too much higher, too much lower, unless we get a sharp move higher in yields, which would again accompany higher economic growth expectations in the market, so higher GDPs, and we'll get a new GDP estimate tomorrow to see if we're continuing to maintain a plus 3% estimate for the next quarter, making that 3 quarters in a row of 3% gains. Energy, you can see, energy was down below. So energy had been really, really weak, was well below its 200-day moving average just a few months ago before really sparking, catching a rally and making a strong move higher. Now obviously well up above its 200-day moving average after getting a golden cross. Remember, after you get golden crosses, you get tests of the 200-day moving average typically before you continue to trend higher. You can see if I were to go back even further, back here in 2012, so you got a golden cross. We did get a test of the 200-day moving average at the end of 2012, so we're getting a golden cross here again, 50-day above the 200-day. We kind of got a test there. I wouldn't be surprised if we got another test after we hit some resistance at the 75 level, make another test of that 200-day moving average before continuing to trend higher into the end of this year. This year being the year I expect commodities and energy to be outperformers after multiple years of underperforming. So with today's trade idea, I wanted to think internationally again. And again, those emerging markets in China, you can see a stock like Alibaba doing very, very well this year, doubling from 90 bucks up to 180 bucks. We pulled back 190 bucks. Pulled back below 170, but you can see we were trading lower and then going sideways around the holiday until today's breakout move above these kind of near-term high points here, breaking above the 30-day moving average, the 8-day crossing above the 17-day, which is a result of that MACD crossing above zero. If you can see on the Bollinger Bands, which had really come down, we broke out above the upper Bollinger Band. So quite the breakout move for Alibaba. Again, not looking for extended bullish runs right now because of this potential intermediate low point that we're looking for in January. So not too aggressively bullish, but we can take advantage of breakouts like this. So one way to do it, again, when we're not aggressively bullish, is to sell puts. We'll sell puts in that 30 to 40 delta range going out about 45 days for February. So we'll sell that 175 put, buy the 170 for protection. 175 happens to be where the low end of today's candle is, so it almost would nullify the breakout today, getting back below the 30-day moving average, getting back below the 8-day moving average for that matter. And then you can see too, if we were to get back down to this 172.5 level, which is where that crossover point is, we're looking, no matter what day we get there, we're looking at about a $100 loss compared to about a $139 gain. So pretty decent reward to risk ratio here for Alibaba, trying again taking advantage of this this international theme we're talking about, as well as some pretty positive technicals that suggest that we could get a decent bullish run. Again, similar to the technicals we saw on Netflix last Thursday that prompted that trade idea. Very similar here, but again, not expecting an extended run. Just looking for an opportunity due to the breakout. You do have earnings coming out here on the 22nd. You can see how earnings impacts this stock. Not too negatively or not too positively either. At least not compared to the type of move we've already had today. So we'll keep that in mind too as we look for, we'll position size around this maximum loss of 361 bucks. So that will help to take away the risk of the earnings if we're position size for that maximum loss, knowing that the true reward to risk ratio is going to be right around this, a little bit more than 1-to-1 ratio, and pretty decent odds of success because of that earnings announcement. The higher probability is baked into the higher volatility, is baked into the premiums, the higher premiums we're getting, which for a $5 wide spread, we're typically shooting for $1.16. We're getting about $1.40, but that doesn't impact the odds too negatively. We're actually closer to 70% odds of success here. And of course, if we want to account for the higher risk of that earnings announcement, we can just not only position size around maximum loss, but also position size with a smaller position than normal. So cut your normal position in half, for example, to account for the extra risk. But knowing that here's a pretty decent technical setup with some decent odds of success according to the premiums that you're getting because of that earnings announcement that's expected on the 23rd or 22nd here before the market opens. So in summary, the market's bounced today, a near-term bounce on a persistently strong bullish posture. Just don't put a lot of stock into this bullish bounce. Don't expect it to last as long as a typical near-term bullish run. We're getting a lot of near-term volatility, which means we're nearing the end of an intermediate, this bullish intermediate run that we've been on for 4 months now. We're starting this intermediate pullback. Intermediate pullbacks like this from strong bullish highs are not, there's no V top, so it's going to be a slow grind, intermediate grind down to a new intermediate low point, at which point we'll have a good opportunity for a bounce. And depending on how low market sentiment gets, will give us an idea of how long that new intermediate bounce will be, probably towards the end of January, beginning of February. So again, thanks for watching tonight. I appreciate the time that you spend watching these day in and day out. Let me know what you think by clicking that like down below, that thumbs up. Let me know that you found the video useful. Remember to also subscribe to the YouTube channel, comment on anything that stands out to you down below. Follow me on Twitter, join the Market Outlook community on Facebook with the address that's down in the description below. Have a great evening, everybody. We'll see you all tomorrow.